I'm doing this video today because as a financial planner, just when you think you have Social Security filing strategies all figured out, you discover new ones. I received a call yesterday from a retired police officer that was 63 years old, was receiving his pension, just turned on his Social Security benefit, but he informed me that not only was he receiving Social Security payments for himself, but he was receiving Social Security payments for each of his 3 minor children to the tune of about $700 a month each. I had never heard of this before. At first, I didn't really believe it, and then I actually did some research and I realized this is actually a thing. Social Security has dependent benefits available for people that are 62 or older. They've turned on their Social Security benefit and their kids are under the age of 18. So I'm gonna go through those with you today. There are 3 requirements that would make your children eligible to receive these dependent benefits from Social Security based on your retirement benefit. So the parent has to be at least 62 years of age or older. The parent has to have physically turned on their Social Security benefit. So it's not like you can just wait until normal retirement age and your children starts receiving these payments. You actually have to be receiving those payments yourself in order for your children to be eligible to receive their benefit payments. And the third one is your child has to be unmarried and meet one of the following criteria. They either have to be under the age of 18, they have to be between the ages of 18 and 19 and still be a full-time student K through 12, or they're age 18 or older with a disability that began before age 22. Let's assume you and your children meet all of these requirements and you're considering turning on your Social Security benefit at age 62. For anyone that's done their Social Security homework, your full retirement age, when you're entitled to your full Social Security benefit, if you're born 1960 or later, is age 67 right now. If you take it early, let's say at 62, they reduce permanently your Social Security benefit for the rest of your life by small amounts each year. And if you take it at 62, it's about 70% of the full benefit you're entitled to. So the question is it worth taking that permanent reduction if my kids are receiving those payments, and how much of those payments to my kids? The amount of the benefits that your children are able to receive from Social Security under these dependent benefits can be substantial because they are eligible to receive up to 50% of your full retirement age benefit. Each of your kids are eligible to receive 50% of your full retirement age benefit. So again, let's say your full retirement age benefit at 67 would have been $1,700. But by you turning on at 62, let's say you only get $1,200, but then that opens a door for your minor children to receive payments. Their 50% is not based on your $1,200. Their 50% is based on your $1,700 that you would have received at full retirement age. So you would receive $1,200 and each of your minor children could receive $850 per month until they reach age 18. The way those $850 payments to your children work is it continues until the month of their 18th birthday. So if you have a 12-year-old and they're going to receive this $850 per month every single month, that's a number of years that they're going to receive roughly $10,200 a year until those payments stop. And that money could be used towards, purchase of a first car, towards college expenses, maybe the down payment on their first house. There's a lot of possibilities. There is a family maximum benefit threshold, which means if you have 10 children, you're probably going to bump into this family maximum benefit, which says your dependents can only collect up to 150% of your full retirement age benefit for Social Security. So let's say your benefit at full retirement age is $2,000. They're going to cap $3,000 is the most that all of your dependents can receive based on this dependent benefit. Now, are your children going to have to pay tax on these Social Security benefit payments received by them? They are considered payments directly to the children. It's considered their taxable income. Social Security is taxed at the federal level above a certain threshold. And what that threshold is about $25,000. And this is how the calculation works. You total up all your children's taxable and non-taxable income. Let's say they have W-2 jobs and whatnot. Those count 100%. And then you take 50% of the benefits that they receive from Social Security and add that to the calculation, if their total income plus 50% of their Social Security benefit is under $25,000, they will not owe any federal tax on the benefits that they received. If they go above that, then they may owe some tax on a portion of that Social Security benefit. That's at the federal level. States have their own rules when it comes to the taxation of Social Security. Many states do not have any taxation at the state level on Social Security benefits, but there's about 13 states that actually tax Social Security in one form or another. So you just have to look into it and see if there's going to be state tax owed on these benefits paid to your children. Another natural tax question that comes up is if your children are receiving all this income from Social Security, can you still claim them as a dependent on your personal tax return? And as long as your children still meet the definition of dependent, the answer is yes. They can both get the Social Security payments and you can claim them as a dependent. Let's talk about how you apply for these Social Security payments for your children. They do not actively advertise that this is available to you. You have to proactively apply for these. You can't apply for dependent benefits online. You actually have to call Social Security or schedule an appointment at your local Social Security office. There is one big pitfall that families can run into with this filing strategy, that if your children are receiving these Social Security benefits and you're saving them for college or something in the future, when they turn 18, you may get a letter from Social Security saying if you conserved or saved any of these benefits that were paid to your child, we want them back. Now there's a workaround for this, but before I do that, let's kind of talk about why they ask for the money back. So the premise behind why they give these dependent benefits is they assume, hey, if someone retired at 62 and their income dropped and they still have minor kids in the house, they may need additional income to help subsidize the expenses until the kids have reached age of majority. And if you haven't spent it, then we want that money back. Now, regardless of your income situation, does not preclude you from applying and receiving these benefits, but you have to know how to title the account that these benefits are being deposited to. The titling of the account is very important here. So all these Social Security benefits that are coming on behalf of your children, if they're being deposited to an account that you own or that you co-own, you're a joint owner with you and your child, they can legitimately ask for those saved benefits back. But if the account is solely in the name of your child, you do not have to refund those saved benefits to Social Security. There are a few ways to establish accounts just in the name of the child. So some banks at, let's say, 14 will set up a savings account in the name of the child, and then the parent is just added as a custodian. Child owns it 100%, but the parent just oversees it until they reach age of majority for the state, which may be 18, and then they have full control over the account. The other is something called an UTMA account. An UTMA account, the child again owns 100%. Parents add it as custodian and they own that account 100% and have full control at age of majority. That's another way. You know, the misstep you got to watch out for is sometimes parents will set up 529 accounts, college savings accounts. They'll say, well, I'm getting the Social Security payments. I'm going to put in the 529, get potentially the state tax deduction, get the tax-free accumulation. It's natural because they want to use this money for college. But the problem is a lot of 529 accounts, even though the child is listed as a beneficiary, the parent is technically the owner of that account, which then would make it subject to that refund requirement. You can establish 529 accounts as UTMA accounts, and that may be the safer way to go, saying this is now actually owned by the child for the child, so it may not be subject to that Social Security refund. While we're on this subject of college, it's also important to know that these assets in the child's name can negatively impact the FAFSA calculation, financial aid for college, because technically any asset that is in the name of the child, when you file the FAFSA application, that balance counts 20% against whatever financial aid award that they would receive. So if they have $100,000 sitting in their account, $20,000 per year would count against their financial aid award, which is not great, but it's not the end of the world, because when you think about it, that $100,000, if you received it all from Social Security, was money you never had. So yes, $20,000 is counting against, but that other $80,000 in the account you would have never had. To bring this all full circle, if you're 62 and have minor children in the house, it very well could make sense to turn on your Social Security benefit early. But you have to be aware of the other elements of Social Security filing, which is, the survivor benefits to your spouse, the permanent reduction, the earned income penalty if you're still working. You have to look at all of these things before you just blindly pull the trigger and turn on your benefit at age 62. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.